Hey, what's going on today, team? Happy Tuesday to you. Thanks so much for joining me on the January 25th edition of SRT Live with me, Sean Richard. We are here for your weekly market update, and we've got a lot of data to cover. Last week, we got some important information. This week is going to be a blockbuster week. We've got the Fed meeting this week, so we're going to talk a little bit about that. I'll get into my thoughts and where I think the market could be heading based on what the Fed elects to do, both short term and long term. So let's dive in. So today we got two home price index reports. We got one from the FHFA, the Federal Housing Finance Agency, that indicated that on a month-over-month basis, we saw a 1.1% increase in home prices. And so that is just an indicator that home price appreciation is still running pretty red hot. It's calmed down a little bit. 1.1 extrapolated over a year is only about 13.2%. So not the 18%, 20% numbers that we've seen, but anything north of 10% is still running pretty hot, especially for us here in North Texas, where on average we're hovering in that 3 to 5% range on a year-over-year basis. We also got the Case Schiller home price index report, which a little bit more conservative on the month-over-month that it came in at 0.9%, so still really hot. And on an annual basis, it's got home price appreciation at 18.3%. So still red hot. Home prices still rising. You've heard me talking about this for weeks, almost months now, that we're seeing some incredible appreciation in the housing market with the low supply and the high demand. I do want to make a note about inventory, and I'll talk a little bit more about this later. But last week, the National Association of Realtors came out and indicated that for December, we only had about 910,000 homes for sale across the country. Now let that sink in. The entire country, 910,000 homes. As a quick comparison, back in 2007, before we had the crash in 2008, we had 3.7 million homes for sale. We are almost at 25% of the inventory since 2007. So inventory very, very low. All right. So I talked about home price appreciation. It's still staying hot. Last week, as usual, we got the jobs report. We saw a tick up in the unemployment claims. So we get two things every Thursday. We get the initial unemployment claims, jobless claims, and then we get the continuing claims. So last week we had the week prior, we saw 231,000 new initial jobless claims. And again, initial jobless claims are individuals filing for unemployment for the first time. So 2 weeks ago, we had that number come in at 231,000 filings. Last week, which is again for the previous week, we saw that number tick up to 286,000. So we really want to keep an eye on this because that's a pretty sharp increase, a 50,000 filing increase over that week. Now, we've seen a spike in Omicron cases, and so that very well could have a role in why we saw the increase. But if this increase becomes a trend, we're going to have to look at other pieces of the economic puzzle to try and figure out where we're headed, what this means. So we saw the increase. And as such, we did see an increase in continuing claims, people filing or renewing their unemployment status. So a few weeks ago, 1.55 million. And then last week, the numbers came out 1.635 million. So about a 80,000 increase there. So we're seeing unemployment tick up a little bit. Again, there's a number of potential reasons for that, Omicron being one. With that much of a rise, we want to watch that going forward because that's a very telling economic indicator of the health of our labor market. So that came in last Thursday. And then we also got existing home sales. So this is closings on existing homes. So not new builds or like that, but existing properties. So month over month, and this is for the month of December. So month over month, we actually saw a decrease from November of 4.6%, and we're down year over year 7%. Now, there's a number of reasons that this could be the case. Statistically speaking, December is typically a slower month. You've got the holidays, so less people probably putting their homes in the market, less people actually going under contract. That plays a role. Obviously, Omicron picking up a little bit through the winter months, that may have had an impact on that. But to be honest with you, probably the number one component of this, in my opinion, is inventory. We have such short inventory. If we have less homes on the market, then we can't have as many sales. If the inventory continues to decline, we can't sell more homes that are on the market. And so I think that's a big part of why we saw that decrease in December. But we do want to watch this, as always. Anytime we see numbers that are maybe an indicator of moving in a negative direction or a less than favorable direction, it just means that we want to keep an eye on the readings going forward, so that way we can get an idea if this is a trend or if this is more of an anomaly. So that came out last week as well. I talked about the inventory, 910,000 for December. That's down from 1.1 million homes in November. So we're down almost 200,000 homes over that from November to December. So we're definitely moving in the wrong direction. Again, time of year is going to play a role, but let's see what those numbers look like as we head into the spring buying season and, of course, into the summer buying season. We also, let's see here. Gotcha. So I also, want to touch on demand. We're seeing, the other reason we're seeing such decreased inventory is that demand. We are seeing a spike in demand over the last 12 to 13 months. Part of that's going to be based on population growth. You've heard me talk about this before as well. But part of the demand component of our supply demand in the housing market is the millennial generation. Millennial generation is the largest generation in our country's history, and they're reaching that first-time homebuyer age at 27 to 34 age range. And so we've got that spike in demand coming into the market, and you couple that with low supply, and it's just creating that shortage in inventory while keeping demand up. That being said, as you've also heard me say, that is driving the health in the appreciation rates. That is why, it's part of the reason why we're seeing such significant appreciation rates, is we've just got such immense supply and demand, such immense demand and not enough supply to cater to it. Looking ahead this week, again, blockbuster week. We've got the Fed starting their meeting today. We're going to hear from the Fed tomorrow with their interest rate decision. That is, so interest rate decision tomorrow. On Thursday, we get GDP reading, and then we also get jobless claims, unemployment claims, as we always do on Thursdays, and we get pending home sales. So this is contracts on homes haven't closed yet. And then on Friday, we actually get PCE, which is personal consumption expenditure. This is actually the Fed's favorite indicator of inflation. So it's definitely a potential market mover. We want to watch that. Now, talking a little bit about, what I'm keeping my eye on, what I think would be great for all of us to keep an eye on going forward. A couple things on inflation. We're seeing wage pressured inflation. There was a survey done by Momentum Poll that indicated 17% of workers, okay, less than 1/5, 17% of workers indicated that raises that they've received were not sufficient to help them keep up with inflation. So what does that mean? That very well could mean that we're going to continue to see wage pressured inflation. We're going to continue to see employers having to constantly offer and pay employees higher wages to retain them or to attract new employees, new talent to their companies. So wage pressure inflation is something that's continuing to drive higher. And so we need to watch that as wage pressure inflation continues to rise. Supply chain shortages continue to be an issue. It's going to drive overall inflation higher, and we're going to see, inflation is the enemy of interest rates, so that has the potential to drive mortgage rates higher as well. Inventory and home sales. I've kind of already touched on this a little bit. Many reasons why we saw a dip in home sales in December, the holiday season, the Omicron virus, and I would say even rising interest rates. If you're a homeowner, or if you've got homeowners that they'd like to move, they'd like to buy something, but it's not critically high on their priority list. Right now with home prices up so much, they've got to make a decision. Does it make sense to buy a little bit, less home for more money, probably at a higher interest rate than they have right now? And so that cost increase is something that they've really got to have that, deliberate on and make a decision on how motivated they are to buy. Now, what recently has probably also played a role in that is the stock market. Lately the stock market has been taking a bit of a tumble. We've seen a correction. I think we're down anywhere from 10 to 18% in the overall market over the past several weeks to month. And when you are contemplating a large purchase, but you see your asset balances, your investment accounts, your retirement accounts, you see those start to dwindle because of a correction in the market, it typically makes the average consumer a little bit more hesitant to make any large purchases. And so that could be playing a role in that low inventory and the lower home sales as well. So a lot of little pieces that as an aggregate add up to explain why we're seeing some of those lower numbers. But we want to keep an eye on it. And then lastly, I'll get into the Fed interest rate decision. So we've got that coming up tomorrow. The consensus is that we're going to see several rate hikes from the Fed, in the Fed funds rate over the course of the year. And the market is anticipating the initial Fed rate hike in March. However, the Fed could surprise us and do an initial rate hike tomorrow if they feel that the current economic status it requires that. It requires that level of urgency. And we could see another one in March. Now analysts, there's several analysts that are predicting how many rate hikes that we're going to be looking at. The general consensus is we're probably going to see 2 to 3. There's some analysts that are saying that we might see 5 to 7 rate hikes. And if that happens, we've got to be on guard, because when we get those rate hikes, it's going to accelerate the short-term interest rates, like the 10-year, the 2-year Treasury. And although the 10-year Treasury is at a healthy level above the 2-year right now, we could see the gap between the 10-year Treasury and the 2-year Treasury start to shrink. And if we get an inversion of that yield curve, and I'm going to share this with you actually, if we get an inversion of that yield curve, then that could potentially spell inflation. That's been a very reliable indicator that after a yield curve inversion, after that 2-year gets higher than the 10-year, that has typically in the following 6 to 12 months resulted in an economic recession. So we need to keep an eye on that. So there we go. So this is the yield curve, the Treasury yield spread. I've got the 10-2 up here. So you can see these red indicators here, the dips where the 2-year has, or the 10-year has dipped below the 2-year. And then these gray sections indicate a recession. So we've seen that almost exclusively every time. And we're getting to the point where we've got a downward trend right here in that 10-year to 2-year gap. So we need to keep an eye on that. It is a recessionary indicator, but that's why the Fed has monetary policy levers that they can pull to help straighten the ship, so to speak. So we're going to keep an eye on that. I also want to show you the current mortgage-backed security, mortgage bond levels. So last week, we saw mortgage-backed securities take a tumble. I mean, you've got these, these red downward bars here. Mortgage-backed security prices took a tumble, and which drove interest rates up. They have an inverse relationship, mortgage bonds to interest rates. But we've seen some improvement. However, this black line here, we call it a Fibonacci line, and that as acting as a level of resistance. Now we've broken above it currently, but we are just barely above it. If we can hold above that, we've got some room to the upside. We could see some temporary short-term improvement in interest rates. But if we break back below this, we've got a long ways to go before we hit the next floor of support. And so that could spell some increasing interest rates. So all of the information that I've talked about today, that all goes into how these markets are moving and which direction we see from, say, the 10-year Treasury, the mortgage-backed securities. You see the 10-year Treasury is up 3 basis points today. And so it's a combination of all this. These are things that I'm looking at. I want to make you aware of them so that way you can have more articulate conversations with your clients. If you're a homeowner, you can be more apprised of what's going on in the market, how that influences your home price, your appreciation, and how that impacts your day-to-day financial, your day-to-day financials. When you go to the grocery store, what it's going to cost you there. When you see prices rise, I want you to understand why those things are happening and be able to, again, articulate that as needed. So, my personal thoughts right now, I think that we're going to see the Fed hike the interest rates sooner rather than later. Will we see a rate hike tomorrow? I would put that percentage as probably lower percentage, maybe a 25% chance. I think March is the target, but you never know what could happen. That's why they are the Fed and I am a mortgage loan officer. But we could see that happen as early as tomorrow, but I think March is likely going to be our first rate hike. And then the question is going to be how many more that we see over the course of the year. And the Fed's going to be monitoring a lot of these data points, obviously with inflation, the personal consumption expenditure coming out Friday. We'll see where that lands because that's going to be a big component of what the Fed takes into consideration of where inflation is headed. But the Fed is very, they're backwards looking, right? They're all this data that I'm providing you with. This is all backwards looking, and so the market, however, is forward looking. The market is pricing in anticipated information in the future. And so there's a bit of a disconnect there. And so when the Fed is making this monetary policy, when they're pulling these levers, they can only base it off of what has happened and what direction that they want the economy to move in. And so there's always this lag between where we're at and where the Fed wants us to be. So hopefully they can make the right moves, do a little bit of lever pulling with the rate hikes, get us back to a place where we can see mortgage rates kind of level off, not so much volatility. And hopefully, if you're invested in the market, we can get to a point where the market starts to run up a little bit again. We'll take this correction in stride, and hopefully we can grow from here. But as always, if you have any questions or if you want to nerd out on any of this information, please don't hesitate to reach out to me. You've got my contact information below. Feel free to leave comments or questions in the comments below. And I will be actually back this Friday with another Friday business building. We are going to talk about reviews, building a process around obtaining reviews. This is for you real estate agents out there. So tune in the Facebook, the private Facebook group, Powerhouse Real Estate, and we'll go over that so that way we can help drive your business further with focusing on reviews. Have an incredible rest of your Tuesday, and I will catch up with you next week with another market update.